In the previous session, we understood that the forward rate today must be equal to the spot rate into 1 plus the domestic rate of interest to the power t upon 1 plus the foreign rate of interest to the power t. The domestic currency is also represented as currency A in a lot of notations in the curriculum, and the foreign currency is also represented as the currency B. The foreign currency is also known as the base currency. So this was a no arbitrage relationship, and hence we called it the covered interest rate parity. It was covered because it was a no arbitrage relationship, and we even studied how to exploit the arbitrage if f was anything different from this number. The uncovered interest rate parity tries to say that the expected spot rate at the time t equal to t in the future is also equal to the same number, that is 1 plus RA upon 1 plus RB to the power t. Please note, this is uncovered because there is no bounding condition or there is no arbitrage condition which forces this to happen. The spot rate of the currency at a time equal to t can be any rate. It will depend on demand, supply, it will depend on a lot of factors that we'll see in the coming slides. So the uncovered interest rate parity generally does not hold in the short run. However, the uncovered parity argues that the forward rate is an unbiased estimator of the spot rates in the future, or the expected spot rate would be given by the same relationship, that is, if the domestic currency has a higher rate of interest, then the domestic currency will see the currency depreciate. If the foreign currency has a higher rate of interest, then the foreign currency will see the currency depreciate. Please note that the uncovered parity generally does not hold in the short run, but in the long run, rates seem to have better moved in line with the uncovered interest rate parity, or you can say holds better in the long run. Suppose that the spot exchange rate is USD per euro as 1.35, or it is 1.35 USD per euro. The 1 year nominal rate in the eurozone is 12%, and the 1 year nominal rate in US is 6%. Calculate the expected spot rate 1 year from today using the uncovered interest rate parity. So the expected spot rate would be the same as the forward rate today, that is the spot rate into 1 plus the domestic currency or currency A, that is USD, that is 0.06 upon 1 plus 0.12 to the power t, that is equal to 1, which comes out to be approximately 1.27 USD per euro. So we see the euro has depreciated as the interest rate was higher. The next forex parity relationship that we'll study is a very important one. It is called the Fisher relationship. The Fisher relationship says that the quoted interest rate in any country, or the nominal interest rate in any country, is equal to the real rate of interest plus expected inflation. So investors need to be first compensated for inflation, otherwise they will never lend their money, and then on top of that there is some real rate of interest. It further argues that differences in nominal rates between countries or between different countries can completely be explained by differences in the expected inflation. In countries where expected inflation is high, the rate of return offered has to be higher. In countries where expected inflation is lower, the rate of interest can be lower. A real rate of interest, that is given as the nominal rate minus inflation, tends to be more or less constant across geographies. If one geography has a higher real rate of interest than the other, then money would flow into the geography with the higher rate and currencies would tend to appreciate. So, nominal rates are explained mainly by inflation differentials according to the Fisher relationship. So, this is referred to as the real interest rate parity. That is, real rates are assumed to converge across different markets. So the linear approximation is what will be used and what is now in the curriculum, which says that the difference in the nominal rates between two countries is explained by the difference in the expected inflations. Real interest rates are constant across the world. Suppose that the nominal US interest rate is 10% and the expected inflation rate is 4%, calculate the real interest rate. So the real interest rate would be equal to the nominal rate minus inflation, that is equal to approximately 6%. You could also use geometric compounding or geometric mean and say that 1 plus the nominal is equal to 1 plus real into 1 plus inflation. Both will give us approximately the same answer. Both are allowed on the exam. You can very well use the linear approximation and go ahead to the next question. Suppose that the Eurozone expected annual inflation rate is 10% and the expected US inflation rate is 12%. The nominal interest rate is 11% in the Eurozone. Use the international Fisher relation and its linear approximation to estimate the nominal interest rate in the US. So nominal once again is equal to real plus inflation. The real rate is constant across geographies. So in the Eurozone we see the nominal rate is 11 and inflation is expected to be 10%. Which gives us the real rate to be equal to 11 minus 10, that is 1%. We can apply this calculation to calculate the nominal rate in the US, which will be given as the real rate, that is 1%, plus an inflation expectation of 12%, giving us a total rate of 13%. A very interesting and important concept is that of the real exchange rate. The real exchange rate essentially is the absolute amount of real goods or actual goods that you will get in one country by exchanging actual goods from another country. So if I have a loaf of bread in India and I exchange that loaf of bread for a similar quality, similar quantity loaf of bread in the US, based on the current rates, how many loaves will I actually be able to purchase or get is the real exchange rate. Now, for many reasons, the real exchange rate may or may not be equal to 1. That is, one loaf of bread in India of exactly similar quality may or may not exactly be equal to one loaf of bread in the US for transportation, many other reasons. The purchasing power parity that we will study next, rather the absolute purchasing power parity, argues that on an average the real exchange rate should be equal to 1. Just a loaf of bread may not be the same price, but if we take an average basket of goods in India and an average basket of goods in the US, then both of them should be exchangeable, or the price of both should be the same in both countries. Otherwise there will be an arbitrage opportunity. We can buy in India and sell in the US and vice versa. Let's first calculate the real exchange rate. Please note, the real exchange rate has no units. It is not USD upon INR or Euro upon USD. So starting with the nominal rate, you only have to make this quantity unitless. So if the spot rate is in, let's assume, USD upon euro, then to calculate the real exchange rate, you need to multiply by the price of the basket in euro or in euros and divide by the price of the basket in USD. Once you do that, the units will cancel and the remaining will be the real exchange rate. So we'll do it with an example. Let's assume that the price of a consumption basket in India is 50 INR or 50 rupees, and the price of the same basket in US is $2. So it's the same basket of goods that we are comparing. This is the price in India and this is the price in US. The nominal exchange rate is given to be 50 INR per USD. Question asks, compute the real exchange rate. So once again, we'll apply the same concept. The real exchange rate will start with the nominal and then make the quantity unitless. That is, multiply by the price in USD, that is $2, and divide by the price in INR, that is 50 INR. So the real exchange rate will come out to be 2 units or 2 by 1. So it was in 50 INR per USD. How many INR for 1 USD? So this exchange rate will also be 2 baskets in India is equal to 1 basket in the US. And we can see that also because for 50 INR we'll get 1 basket. Let's say we had 1 basket in India. That 1 basket could be sold for how much? 50 INR. If it's in India, it can't be sold in dollars. It can be sold in INR. So for the 1 basket, we will get 50 INR. With 50 INR, how many USD will I get? 1. With 1 USD, how many baskets will I be able to purchase in the US? Half. So 2 baskets in India are equivalent to 1 basket in the US. That is the real exchange rate, that is 2 upon 1 that we derived. The absolute purchasing power parity says that the real exchange rate must be equal to 1. That is, the price of the basket in India must be equal to the price of the basket in the US, otherwise there is an arbitrage opportunity. For many reasons, the absolute purchasing power parity does not hold because first of all, people's consumption basket is different. In one country people consume rice, in another country people consume more wheat, and hence prices of or the basket of consumption is not comparable, hence prices are also not very comparable. Then there are inefficiencies, there are laws, regulations, tariffs, import barriers, etc. that can cause the absolute purchasing power parity again to not hold in the short run. In the long run, currencies and prices may move according to the law of one price or according to the absolute purchasing power parity, but we have not seen this to hold in the short run. The relative purchasing power parity says that whatever be the nominal rate today, incremental appreciation or depreciation in the currency will be in line with the change in prices. So in countries where inflation is high, inflation high essentially means what? That the currency is losing value. If inflation is high, that means same dollars are earning me or are bringing me less goods tomorrow than they were today because prices are going up. Inflation is nothing but the loss in value of the currency. So the relative purchasing power parity says that countries with higher inflation will see a depreciating currency, and countries with lower inflation will see a appreciating currency. So the spot price in the future is the spot price today adjusted for the inflation differential into 1 plus the inflation in A upon 1 plus the inflation in B. Please note that this is consistent with the Fisher relationship that we studied earlier and the purchasing power and the interest rate parity. The interest rate parity had ST as S naught in the uncovered interest rate parity. Said that the expected spot price will be S naught into 1 plus interest rate of A upon 1 plus interest rate of B. If the real rate is the same, then the difference in interest rate is primarily because of difference in inflation. So the relative purchasing power parity can also be derived by combining the interest rate parity and the international Fisher relationship, and we have otherwise also qualitatively argued that inflation means loss in the value of the currency or a depreciating currency. So again, the same or a similar implication as of the interest rate parity. Countries with higher interest rates will see depreciating currencies. Higher interest rates is because of higher inflation. Hence, countries with higher inflation will also see a depreciating currency. Higher inflation means that that currency is not going to be able to buy you as much today, or rather as much tomorrow as it is buying today. So the spot price or the spot price in the future is equal to the spot price today into 1 plus inflation in the domestic upon 1 plus inflation in the foreign currency to the power T. In the ex ante version of the relative purchasing power parity, we replace this with expected spot rate as the spot rate today into 1 plus the expected inflation in country A upon 1 plus the expected inflation in country B. The current spot rate is 1.3 USD to euro. You expect the annualized European inflation to be 5% over the next 6 months and the annualized US inflation to be 3% over the same period. According to the ex ante version, what is the expected spot rate in 6 months? So the expected spot rate would be the spot rate today into 1 plus, this is A upon B, 1 plus the inflation in the domestic currency upon 1 plus the inflation in the foreign currency. So 1 plus 0.03 divided by 1 plus 0.05. Rates will always be annualized. If it's a 6 month, then we raise it to the power 0.5, that is half a year. So it will come out to be 1.123 USD per euro. Or we see again that euro depreciates because the inflation in eurozone is higher than the inflation in the US. Since euro has higher inflation, we expect that euro will depreciate relative to the USD. To keep the cost of goods and services the same across borders, countries with higher rates of inflation should see their currencies depreciate. If the currency did not depreciate, then goods will become more expensive in the country that is seeing inflation. If goods become expensive but currency depreciates, then to the eurozone or to the US consumer, the cost of euro goods remains the same. Let's say he had 1 USD and 1 USD was bringing him 1 apple in Europe. If the European apple goes up by 10%, he will not be able to afford it. But if the currency depreciates by 10%, he would still be able to afford it. So to maintain parity in prices in country, assuming there is no inflation in US, if there is a 10% inflation in euro, then there has to be a 10% depreciation of the currency so as to still keep the parity in prices and affordability. A very important method of accounting used to keep track of our transactions with our neighbors, that is, other countries, is referred to as the balance of payments accounting. Please note, balance of payments account do not have entries within the country. Whatever sale, purchase, investment may have been made by us in our own country will not be recorded in this account. Balance of payments accounting would only track transactions between us and our trading partners, that is, us and other countries. So we used to keep track of transactions between us and our trading partners. Trading partners include government, business, and consumer transactions between countries. It reflects all payments and liabilities to foreigners as well as those received from foreigners. The balance of payments equation is that the current account plus the financial account plus the official reserves account must equal 0. Current account is the trade, the import and export of goods and services that happens on an annual basis. Financial account, also referred to as capital account, contains capital investments into our country or out of our country. Capital investments like equity and debt. This is trade. This is equity and debt. Official reserves is the reserves kept by the central bank of the country of the foreign currency. Generally, the official reserves account does not fluctuate much. So for the purpose of analysis, it is often done that the official reserves account is kept constant and we try to see the changes in the current account and the capital account. So as to say, if current account is negative, to make this whole equal to 0, the financial account must be positive. That is, current account, we'll see in more detail in the coming slide, is basically our exports minus imports. If it is negative, that means we are importing more. If we are buying more than what we are selling, then we will have to borrow because we sold only so much, but we bought so much. So either we borrow from outside or our currency will depreciate, because to purchase these things we will have to pay in the foreign currency, we will have to pay in dollars. We are not receiving as many dollars because exports are not there. So we have to acquire dollars to buy these additional imports. Either we get dollars from outside, that is, we borrow, we get debt, and we get equity investments from outside. If we don't, then we'll have to sell the rupee or we'll have to sell our domestic currency to purchase these additional imports, and the currency will depreciate. Generally, if current account is negative, financial account must be positive, that is, we must receive debt and equity and vice versa. If the current account is positive, that means we are exporting more. That means we are receiving foreign currency. We can have a financial account that is negative, that is, we can lend to other countries, we can invest in other countries and expect a return. Study in detail, the current account captures the exchange of goods, services, investment income, and any unilateral transfers. Unilateral transfers are like subsidies, aids given by foreign countries to us or given by us to foreign countries. These are not like debt, they don't have to be returned. So anything that is a trade item will be a part of the current account. This summarizes whether we are selling more than we are buying, and hence are we in a current account deficit or a surplus. If we are selling more, we are in a surplus. If we are buying more, then we are in a deficit. The financial account or the capital account captures the flow of funds for debt and equity investments into and out of the country. If somebody gives us a loan, or if somebody takes an equity stake in our companies, then that is a capital account inflow. If we invest in other countries, we give them loans or we buy their equity, then it is a capital account outflow. Please note, capital account inflows today will bring us cash, but at some point in the future they may have to be returned. The official reserve is the reserves of foreign currency held with the monetary authority. Any transactions made from these reserves, that is, if you're selling the rupee or if you're buying more of the foreign currency, then these will be official reserve transactions. Normally, this account doesn't fluctuate much, as we discussed. So economists focus on the first two, that is, a deficit in the current account must be supported by a surplus in the capital account, otherwise the currency will depreciate. We've generally seen that in the short run, the current account doesn't fluctuate as much, and rightfully so as well. Whatever need we had, let's say we needed to import oil, we need to import coal, and we export IT services, etc. Whatever we need to import is not going to suddenly change because it's a day-to-day requirement. Whatever we are exporting also will not suddenly change because it is somebody else's day-to-day requirement. However, capital flows can be very volatile. Investments may come, investments may go out also very quickly if the view changes or some other investment opportunity emerges. So remember, for the movement of currency in the short run, the demand and supply of currency will be impacted by capital flows. So if capital flows increase in our country, that means there is high demand for our currency, and hence the currency will appreciate. If suddenly people repatriate their investments, that is, they sell investments in our country and invest in another country or invest in their home country, then this will create an outflow of capital and the currency may depreciate. So capital flows tend to be the dominant factor influencing exchange rates in the short terms. They are larger and more volatile than goods flow or goods and services flow. In the next section, we'll try to understand the influence of balance of payments accounts on exchange rates. So first, we will see how the current account impacts exchange rates. So remember, a current account deficit may lead to a depreciation in the currency for the following reasons. First is simply the flow mechanism. That is, if you have a deficit, that means you are purchasing more for outside. If you are purchasing more from outside, then you are selling your currency, and hence the currency will reduce in value. Secondly, if you have a current account deficit, then it must be funded by a capital account surplus, or the flow mechanism will cause the currency to depreciate. Even if the current account deficit is followed by a capital account surplus, that means some other country has invested in you, or some other country has given you a loan, some other current country with probably a current account surplus has a capital deficit. Their capital deficit is your capital surplus, that is because they have invested in your country when you have a current account deficit, or they have funded your deficit. Now, when that country decides to rejig its portfolio, let's say it decides that there is too much concentration of my investments in your country, or I have funded your deficit too much, I now want to shift my investments into the other country or into some other country. Then as he rebalances his portfolio, he will have to sell your currency and buy some other currency, again causing the currency to reduce in value. So a current account deficit can lead to a depreciation for various ways. Directly, the flow mechanism puts downward pressure. Even as the capital suppliers to your country change their portfolios, that may again lead to a depreciation in the currency. And finally, the debt sustainability mechanism also argues that prolonged current account deficits may lead to a sudden devaluation of the currency or a sudden reduction in the value of the currency, because if they have been funded by capital account surpluses or by borrowings from abroad, as debt becomes too high and investors question the sustainability of this deficit and they question the sustainability of the debt, they will sell out of your country and they'll buy investments in other countries that they think have better prospects. So a deficit per se may or may not be a good or a bad thing. Generally speaking, a deficit can be taken in negative light, that you are not earning enough or you have to borrow. But if deficit is funded in a productive manner, or if the capital that is received is invested in a efficient manner, then in the future the deficit may be reversed, or as our productive ability goes up and as people start purchasing from us, the deficit will reduce or can even become positive. So per se in the short run, deficit is neither negative nor positive, but if deficit persists for a long period in time, then investors may argue the sustainability of our borrowing and the sustainability of our debt, and as they do that, the currency can come under speculative attack also, and they may actually sell their investments and buy investments in other countries. So the current account influence basically argues that deficits will cause the currency to depreciate and vice versa. The capital account influence is more straightforward. It says that as capital comes in the country, currency will appreciate. As capital goes out of the country, currency will depreciate. Now, even though capital coming in appreciates the currency, central banks and governments are worried about excessive capital inflows. So please note that even though capital coming in to your country will be a good thing in the short run, will bring in more money for your citizens and for your usage, it can create certain problems that you should be aware of and you should be careful about. First, there will be excessive real appreciation of the domestic currency. Excessive appreciation means your exports will become uncompetitive, your exporters will get hit. Second, it may result in financial asset bubbles and even real estate bubbles, because all that money is coming, and if there is no productive investment available, and if there is no company available that you would want to invest in, then that money will be parked in gold, real estate and assets like these, creating financial asset bubbles. It can increase debt by businesses and debt by government, because money is available so everybody is taking it, but it has to be repaid. Capital account inflow has to be repaid at some point in time, and if you haven't productively employed it or used it, then that repayment can become a problem. And finally, it may fuel excessive consumption in the domestic market because there is easy availability of credit. So people may become more prodigal in their lifestyle. They may just spend more even though they don't have the resources or they don't have jobs, etc., to support their level of spending, because easy credit is available. So excessive capital account or excessive inflows can create problems. The capital account influence argues that the real exchange rate at any point in time will be fluctuating and will deviate from an equilibrium value. So this equilibrium value can be derived from the purchasing power parity or any other long-term model that we will study in the coming slides. However, at any point in time, the real exchange rate can go up or can deviate depending on the real interest rate in the country. So if the real interest rate in your country is higher because of as compared to the real interest rate in neighboring countries or in the other country, then your currency will tend to appreciate against the other currency. The real interest rate may go up because if inflation expectations go down but interest rate hasn't changed, or if interest rate goes up but inflation is the same, then real interest rate has gone up. So if your real interest rate goes up, then currency will tend to appreciate. If the risk premium assigned to your country, or that global investors are assigning to your country, goes up for whatever reason, political instability, irresponsible policies, etc. If people think that investing in your country is more risky, then your currency will depreciate. Again, capital flows going out, and here higher interest rates means capital flows coming in. So the real exchange rate will fluctuate around the equilibrium. It can increase temporarily if real rates go up. It will decrease if the risk premium goes up. So several observations can be based on the relationship that we presented in the previous slide, the last relationship. In the short term, the real value of the currency fluctuates along the long term. It is positively related to the real interest rate and negatively related to the risk premium that investors demand for investing in assets denominated in the currency. The real rate increases when nominal rate increases, keeping inflation unchanged. That is when real rate increases. Or when expected inflation decreases, keeping the nominal rate unchanged, again increasing the real rate of return. We studied the Taylor rule a little bit at level 1. We will revise it once again. So Taylor rule is the rule according to which central bank generally tries to decide its interest rate stance, that is, tries to increase or decrease interest rate. The central bank usually has the responsibility of maintaining price stability, that is, keeping inflation within targeted levels, and at the same time ensure growth and GDP improvement in the economy. That is, sustainable level of employment generation should also be done while at the same time keeping inflation in check. The central bank, based on the country's demographics, expected growth, expected target inflation, will have some neutral interest rate in mind, or the neutral real policy interest rate. That is, 2% is the global real return that needs to be provided based on the real rates in all other countries and based on the return that the investor should be given for lending his money. And then the central bank will also need to compensate for the inflation. So it will be the real rate, that is the neutral rate, plus the inflation, that should be the current rate of interest or the target rate of interest. However, the actual interest rate today can be higher or lower than this target, or can be higher or lower than this neutral rate plus inflation, depending on whether the central bank is trying to stimulate the economy or whether he is trying to restrict the economy. If the current inflation is much higher than the targeted inflation, then the rate will be a little higher because the central bank needs to restrict the economy, because he needs to bring inflation down. The bank will also look at the output gap, that is the current GDP or the current output minus the target GDP or the target output. So there is some sustainable level of growth also that we are predicting. If the growth is much higher than our target, then again we may want to cool the economy, as we don't want such rapid growth also, because it may be fueled by investments and it may be fueled by unsustainable factors. So if the GDP growth is much higher than the target, then again the neutral rate, or rather the implied rate or the current rate, can be higher than the target rate, because we want to slow down GDP growth or we want to slow down the output growth. On the other hand, if the inflation is much lower than the target, that means we need to stimulate the economy, we need to stimulate growth. Inflation still has a lot of headroom. Hence, interest rates would be lower, or this addition to the neutral rate plus inflation will be negative. Similarly, if GDP growth is much lower than the target, then again government needs to stimulate investments, stimulate growth in the economy, and that will be done by lowering interest rates, because at lower interest rates people will be able to borrow, set up enterprises and grow the economy. So again, if the current GDP is much lower than the target, this term will add a negative factor to the neutral rate, decreasing the rate of return that the central bank may want to keep. The rate of return would be the implied rate by the Taylor rule, or this is the rate of interest that should be there in the economy, that is the yield on government bonds or the policy rate, the repurchase rate that the government is keeping. Now the real rate of interest at any point in time in the economy would be the current nominal rate minus inflation, or it will be the real rate. From this term, if we subtract inflation, we will get this equation, that is the real neutral rate plus alpha times the inflation gap plus beta times the output gap. So what we're trying to see is that the real interest rate across the world may not be constant, as stated by Fisher. The real interest rate may be increased or decreased by central bank actions. So the real interest rate can be higher than the neutral real rate, or can be lower than the neutral real rate, depending on the inflation gap and the output gap. Burgenland is a tiny mountainous Central European country. Lena Schneider, the head of strategist at Burgenland's central bank, is preparing a report on the country's central bank policy rate. Burgenland's current policy rate is 2.5%. Schneider collects the following information on the country. Assume that Burgenland's central bank wants to follow the Taylor rule using response coefficients as 0.5 and 0.5. Alpha is for the inflation gap, beta is for the output gap. Schneider should most appropriately recommend that Burgenland's central bank do which of the following. So the Taylor rule says that R must be equal to the neutral real policy rate, that is 1.5, plus the current inflation, that is 1, plus alpha, that is 0.5, into the inflation gap, that is 1 minus the target inflation of 2, plus beta into the output gap, that is 1%. So the current output gap is given to be 1. So if we sum this up, R comes out to be 2.5 minus 0.5 plus 0.5, that is equal to 2.5%. So the current nominal policy rate is also 2.5%. Hence, Burgenland's central bank should appropriately leave the policy rate unchanged. We studied various approaches to calculate the long run fair value of the currency. We argued that the absolute purchasing power parity does not normally hold in the short run, but can be used to predict interest rate movements in the long run. The IMF, or the International Monetary Fund, uses 3 approaches to predict or to get an idea about the long run exchange rates. The first is the macroeconomic balance approach, that says that the equilibrium rate will be the rate at which the current account balances or the current account deficit or surplus becomes equal to the sustainable current account deficit or surplus. So according to the first approach, we try to estimate how much should the exchange rates adjust so as to equalize the expected current account imbalance and the sustainable current account imbalance. So let's say our current account deficit currently is 5% of the GDP, whereas the sustainable level is 3% of the GDP. What we'll try to estimate is that what kind of currency movement is needed so as to make this 5% of the GDP 3% of the GDP. Please note that as the currency depreciates, imports will become more expensive, exports will become more valuable, the absolute amount of imports and the absolute amount of exports can also change. So we'll see how the currency changes impact all these phenomena, or all these factors rather, and what is the net impact on the current account imbalance. The level or the currency movement at which we feel the current account deficit or the current account surplus will come in line with the sustainable current account deficit or the current account surplus is the fair long run value, or is the movement of the currency. This is the macroeconomic balance approach. Similarly, the external sustainability approach tries to check how much should exchange rates move so as to force a country's external debt relative to GDP towards its sustainable level. So current debt to GDP, or rather current external debt to GDP, may be high or may be low as compared to peers, as compared to other countries, and as compared to our sustainable target. So the external sustainability approach says that how much should the currency appreciate or depreciate. If the currency appreciates, the GDP in dollar terms will go up. If the currency depreciates, the GDP in dollar terms will go down. So what is that exchange rate at which the external debt to GDP will move or will come towards its sustainable level? The reduced form econometric model approach says that, or tries to construct a multi-factor model depending on inflation, GDP growth, demographics, purchasing power parity. Many factors can be included, and we try to formulate a regression type equation which will predict the movement in exchange rates based on various factors, or the long-term change in exchange rates based on various factors. So there's no details mentioned as to how exactly it is done and how it is adjusted for, but this is the general thinking behind trying to estimate the movement of exchange rates from a long-term perspective as used by the International Monetary Fund or the IMF. We already studied the absolute purchasing power parity, which can also be used so as to get a general sense whether the currency can depreciate or should depreciate, or whether the currency should appreciate. Please note, the long run models may not work in the short run. The demand and supply of the currency will have a high impact in the short run and may cause a similar effect or an opposite effect. We did one example of the carry trade when we saw that the forward rate was not in line with the predicted forward rate, and hence we could borrow in one currency, invest in the other currency, and still make an excess profit. So the carry trade is when the interest rate in one currency is lower than the other, and the currency movements are not expected to be high enough so as to remove that arbitrage. For example, if the interest rate in UK is 5% and interest rate in the US is 2%, and we expect the exchange rate to remain more or less constant, then we can exploit the arbitrage by borrowing in US and investing in the UK. The currency with the lower interest rate is referred to as the funding currency. So we borrow here and we invest here and we'll be able to make a free profit. This is because the expected rate 1 year later is flat. So FX trade attempts to capture an interest rate differential and is a bet against the uncovered interest rate parity. The uncovered interest rate parity says that the expected spot rate will move according to the forward rates, or the UK or the British pound will depreciate. The carry trade argues it won't happen because the actual currency we are not expecting to be any different 1 year later. Of course, there are risks in this trades. The biggest risk is the appreciation of the funding currency or the depreciation of the British pound in this case. So if this currency appreciates, then whatever 3% you have achieved may very well be washed away by the depreciation in the currency. So the risks in the carry trade include exchange rate fluctuations, as we discussed. There is a crash risk. There is a small probability of a huge appreciation in the funding currency. So often we've seen that these low interest rate currencies are the developed markets, and these high interest rate currencies are the emerging markets. And in times of market crashes, there is a flight to quality, and there is a sudden huge depreciation in the emerging market currency. So these crashes have also seen to happen a lot in the world, or they have happened more than what has been predicted by a normal distribution. So there is a small possibility of a crash risk also, which can cause a huge loss. So what we need to do when executing a carry trade is to implement a very thorough and a very robust risk management system. So first of all, we can keep a volatility filter. As the volatility increases beyond a particular point, we close our positions, because then the currency can move in an adverse manner and cause a loss. So if volatility has become very high, then we'll close out our positions, will not be in the carry trade. And secondly, have a valuation filter. That is, trades only happen within predefined valuation bands based on some model. If the currency has appreciated too much, then we may want to take a short position. If the currency is depreciated too much, we may want to take a long position based on some model. So basically, carry trade is fine, but make sure you implement a robust risk management. Now please pay a lot of attention. A relatively difficult model, but very important. The model given by Mundell and Fleming tries to explain short-term movements in interest rates. That is, what impacts and determines short-term movements in exchange rates, not interest rates. So we'll study the Mundell-Fleming model under two scenarios. First is a flexible interest rate regime, wherein interest rate can fluctuate depending on demand and supply and market forces, and a fixed rate regime wherein government ensures that against one currency or against some currency the interest rate is pegged or interest rate remains fixed. In a flexible interest rate regime, where interest rates can fluctuate depending on demand and supply, different monetary and fiscal policy will have different exchange rates or different impact on exchange rates. So we will further split this into two scenarios. First is when the capital mobility in the country is high, and secondly when the capital mobility in the country is low. High capital mobility means that I am easily able to buy and sell assets in this country. If I don't like, I can repatriate my investment. Whenever I like, I can invest again. So theoretically, tomorrow I can take all my money out of the country, and the day after I can invest all my money back into the country. This will be an example of high capital mobility. Remember, in high capital mobilities, whatever our answer is, appreciation or depreciation, it will depend on capital flows. So before answering, you have to see what impact will the action have on capital flows, and hence will the currency appreciate or depreciate. If capital flows increase, currency will appreciate. If capital flows decrease, currency will depreciate. As we've studied earlier, capital flows tend to be larger and more volatile than goods flow or current account items. So it can impact current account items also, but we won't worry about it if there is high capital mobility, because the dominating impact will be from capital flows. If capital mobility in the country is low, that means I'm not allowed to repatriate my assets, or I'm not allowed to invest whenever I like. There are approvals needed, there is restrictions on both bringing in capital and taking out capital. In such a case, we'll assume that capital mobility cannot happen, or it cannot happen very quickly. So the impact on the currency, whatever it may be, will depend on goods flow. Goods flow means imports and exports. They are generally a lower impact than capital flows, but if capital flows are not allowed, then the impact will be from goods flows or imports and exports. So if imports increase, currency will depreciate. If exports increase, currency will appreciate. Is a general thinking that has to be on the back of your mind. Please note, if you understand the reasoning well, you won't have to memorize. Otherwise, people just memorize these tables and go into the exam, and then they forget, because there'll be so much to memorize if you try to follow that approach. Okay, so we understood. In exchange rates are flexible. High capital mobility means focus on capital flows. Low capital mobility is focus on goods flow, and we are trying to see the short-term currency movements based on different actions. Let's first see if monetary policy is expansionary as well as fiscal policy is expansionary. Monetary policy expansionary means interest rates are low. Government is cutting interest rates. Fiscal policy expansionary means the other way around. If fiscal policy expansionary means government is borrowing and spending. So there are various social schemes, tax rates are low, government debt is high, which will generally put an upward pressure on interest rates. So expansionary fiscal policy puts upward pressure on interest rates. We study that in crowding out also at level 1 when we studied. If the government borrows too much in expanding, then interest rates will be up, private companies may not be able to borrow. Anyways, expansionary fiscal policy means increasing interest rates. Expansionary monetary policy means decreasing interest rates. Decreasing interest rates means capital flowing out into countries with higher interest rates. Increasing interest rates means capital coming in to take advantage of that high interest rate. Hence, with high capital mobility, the impact will be uncertain, as one factor is causing interest rates to increase, another is causing the interest rates to decrease. So whichever is more dominating will have the net say. In low capital mobility, the focus does not have to be on interest rates. The focus will be on goods and services. Low interest rates also mean that people will be borrowing and spending, or our imports will go up. Expansionary fiscal policy also means that people have a lot of money in their hands, tax rates are low, so we will be purchasing and we'll be spending, we'll be buying goods, we'll be traveling abroad, we'll be importing more. So under both scenarios, our imports increase. Capital flows are not relevant with low capital mobility. So if our imports are increasing, the currency will depreciate. If monetary policy is expansionary, that is, interest rates are low, and fiscal policy is restrictive, that is, tax rates are high, government is not spending also, government is not borrowing and spending, again will result in interest rates being low because there's not much demand for capital. People don't want to set up businesses because tax rates are high. Government is not borrowing itself and doing anything. So again, demand for money is low. So interest rates will be low. If interest rates are low, capital will flow out. And hence, with a high capital mobility, currency will depreciate. In low capital mobility, we don't worry about capital flows. We worry about goods and services. So the impact will be uncertain because low interest rates means people want to spend more. Expansionary monetary policy is encouraging us to spend more. However, high tax rates and lack of spending by the government is reducing our income or reducing the money in our hands. So one factor is supporting high imports. Other factor is reducing the imports. Hence, the impact will be uncertain. If the monetary takes over, then currency will depreciate. If the fiscal takes over, then the currency will appreciate because we will not be able to afford, will not be able to buy as many things from outside. If monetary policy is restrictive, that is interest rates are high, and expansionary fiscal policy is expansionary, again interest rates are high. Expansionary means government is borrowing and spending, tax rates are low, demand for money is high, so interest rates are high. If interest rates are high, more capital will flow into our country, causing the currency to appreciate. With low capital mobility, don't worry about capital flows now, see what will be the impact on imports and exports. If interest rates are also high, then we won't be able to borrow and buy many things from abroad. However, tax rates are low. So there is more money in our hands, government is spending more, increasing our ability to purchase from outside. Hence the impact will be uncertain. If both are restrictive, so interest rates will be high because of restrictive monetary policy and interest rates will be low because of restrictive fiscal policy. So government is not borrowing much, government is not spending much, lowering interest rates. But central bank is raising interest rates, hence interest rates will be higher. So with high capital mobility, we will have to see the net impact. We can't say for sure what will happen because one factor is supporting appreciation, one factor is supporting depreciation. Overall impact is uncertain. With low capital mobility, we'll have to see the impact on imports and exports, and now both factors are reducing imports. If interest rates are high, we can't borrow and spend. If government is not cutting taxes, again we can't spend because we don't have much money. Hence, the currency will appreciate because our imports will reduce. So very important, the Mundell-Fleming model, a little difficult to understand on your own from the books. So it's good if you've understood, just watch the video again if you ever forget it closer to the exam. And remember that this is with a flexible interest rate regime in the short term. If the interest rate regime is fixed, then all these factors that we discussed play out just the same. That is, the impact will still be the same. There will still be depreciation pressures with high capital mobility, appreciation pressures under different circumstances. Only thing is that the government will have to take an offsetting position if the government has to maintain a stable currency. So if currency is depreciating, then your government will have to, or your central bank will have to buy the currency. If the currency is appreciating, then the government will have to sell the domestic currency or buy the foreign currency in order to keep a stable exchange rate. The next short-term model that we'll study is called the monetary model. So the pure monetary model says that the purchasing power parity holds at any point and output is constant. That is, GDP is constant. So if the number of things are fixed and you follow expansionary policies. That is, you bring in more money, reduce interest rates, print more money. That will only reflect in inflation because output is constant. So if number of things are the same and money is more, what will happen to prices of things? It will go up, or there will be inflation, and inflation will cause the value of the currency to decrease. Similarly, restrictive policies will reduce inflation because if money is less, same number of goods, then prices of goods will go down and currency will appreciate. So pure monetary model says that fiscal or monetary policies have direct impact on inflation. Rather, it doesn't focus on fiscal policies. It focuses more on monetary policies. Fiscal policy is constant and monetary policy has a direct impact on inflation. So if monetary policy is restrictive, inflation will be high, causing a depreciation instantly, and vice versa. The Dornbusch overshooting model agrees with the basic theory of the pure monetary model. However, it further argues that prices are sticky in the short term. So inflation will come, but it won't come instantly. So if today the government cuts interest rates, inflation will not come tomorrow. It will take some time to come. As inflation comes, currency will depreciate as given in the pure monetary model. So if this was the level of the currency, the pure monetary model says the currency will become this much tomorrow as soon as the expansionary monetary policy takes place. The Dornbusch overshooting model says that the depreciation will take some time, and then it says the depreciation can even overshoot. That it will take like this, but people will not price it exactly or perfectly. So often the depreciation will be higher, and so will the appreciation. So Dornbusch just argues that it's not a precise science as given by the pure monetary model. It can take some time to happen, and secondly, there can be an overshooting in both the appreciation as well as the depreciation. The portfolio balance model takes a more long-term view to explain currency appreciation or depreciation. It argues with the Mundell and Fleming model in that this model focuses only on the short run. And that is an issue even with the monetary model, because we are again focused on the short-term inflation when we are explaining currency movements. So we are saying inflation will go up, and hence the currency will depreciate. However, flows into the currency or flows into the country will be dependent on not just short-term movements but also long-term expectations. So even if an expansionary policy causes inflation to go up in the short run, it may or may not cause a depreciation in the currency. If the expansionary fiscal policy means that there will be good investment in the country, good productive assets created, and hence good long-term returns because of good long-term GDP growth, then even though there may be inflation in the short run, foreign investors and other institutional investors may invest in this country and invest in this currency, hence the currency not depreciating, rather appreciating even with inflation coming in the short run. So the portfolio balance model says that the impact of policies has to be calculated from not just a short-term perspective but also a long-term perspective. So an inflation, even though in the short run, may still cause the currency to appreciate in the short run as more money comes in because people have good long-term expectations. So long-term expectations drive current inflows and an appreciation in the currency. Secondly, in the long run, if the borrowing is more and inflation is high, then these steps may have to be reversed. That is, the borrowing will have to be paid back. And when that happens, the currency may depreciate. So in the short run, it may still appreciate and depreciate in the long run. So just remember, the portfolio balance model is a more long-term model. It says that short-term expectations need to be combined with the long-term expectations before you see the impact on the currency. The Mundell, Fleming and monetary models are more short-term models in explaining the currency behavior. We've seen across the world that central banks intervene in the currency markets. The objectives of these interventions are many. First of all, banks may want to ensure that the currency does not appreciate excessively. Excessive appreciation can reduce your exports and make your exporters uncompetitive in the global market. It may want to allow the pursuit of independent monetary policy without being hindered by impact on currency. So if every monetary policy action is having too much impact on the currency, then they may not be able to address domestic issues and follow an independent policy because they are too concerned with currency movements. So they may want to intervene to some extent so as to keep currency within a predetermined range and thereafter follow an independent monetary policy. Finally, we may also want to reduce excessive inflow of foreign capital because of all the problems it may create, as we studied earlier. How effective have central banks been in doing this, however, is questionable. So what we've seen is that for developed markets, the volume of currency traded on a daily basis is just too large against the forex reserves of the central bank. So what can the central bank do in the best case? It can buy and support the currency, or it may sell and depreciate the currency. For that, it needs forex reserves. If it has to buy, it has to sell some other currency. If it has to sell, it has to buy some other currency. So in developed markets, we've seen generally the reserves of the banks are much smaller as compared to the global trade in these currencies. So central banks are not able to intervene and impact much. It is the global demand supply that will decide the currency. In emerging markets, the data is still inconclusive, but yes, some indication is that the central bank may have more forex reserves as a percentage of the total trade in these currencies, and they may be able to impact the currency more than the developed countries. However, again, the size and the impact will depend on the amount of flows that you're trying to counterbalance. If there are consistent flows, then the central bank will be relatively ineffective. If it's a one-time short flow that has to be counterbalanced, then the central bank will be more effective in managing the currency. A currency crisis happens when people lose faith in your currency and we see a rapid depreciation of the currency. So some warning signs or some precursors to a currency crisis or a rapid depreciation in the currency include the following. First, the terms of trade deteriorate. So you're not able to export as easily and you're not able to import as easily. People stop accepting your currency. People say if you want to import, you have to pay in US dollars. Similarly, your exporters also don't agree to favorable terms that they were earlier. So we see terms of trade deteriorating. The central bank reserves decline dramatically, hence its ability to counter or support the currency also goes down. Real exchange rate is much higher than the mean levels. Inflation is starting to increase. High volatility in equity markets, and equity market is experiencing boom and bust cycles. Money supply relative to the bank reserves also increases. So it's an expansionary situation and big money supply is there, causing inflation and causing people to lose faith in your currency. Private credit growth becomes small. So even though there is so much money supply, there's so much inflation, there are no new businesses setting up, or there is no productive activity happening in the economy. So all these signs are some warnings of a currency crisis, that the currency may see a rapid deterioration. Trading and speculation has always been rife in the currency markets. So a lot of technical analysis is used in order to predict currency movements in the short run or in the long run, and people do in fact actually trade on these technical signals. So a common strategy is that of trend following trading rules. That is, when the currency goes above a moving average, it signals a buy. When it goes below its 200-day moving average or 50-day moving average, it signals a sell, so on and so forth. What we've generally seen is that markets in the developed world are now efficient, and hence these trend following type of rules haven't been able to generate any excess return or don't have any predictive power. In the emerging markets, they may or may not work. It's possible that they may work because the markets are not as efficient. There is not as much trading happening in the currency markets of these countries. We can also try to seek information of the dealer order books. So unlike the equity markets, wherein order details are provided by the exchange to everybody, the dealer books, FX is a dealer driven market. So dealers post bid and quotes and then they receive orders. The accumulation and the display of orders of all dealers is much less efficient as in the case of equity markets. So if you find out about big dealer positions, that one dealer has a big buy order or he has a big sell order, and you trade based on that information, then you may be able to generate excess return, or maybe these order book positions may be related to the movement in the currency in the coming days. What we have generally found is that the size of the order is generally related to the short-term currency movement. That is, concurrent movement happens. As the order book comes, at the same time, currency also moves. So if it's a big buy order, the currency would also be moving up. And if it's a big sell order, the currency would have also moved down. But any lagged indications we haven't found. To be actually be able to use this information, it's not the concurrent trade that matters. It's the lagged movement that matters. That is, after I found the information, am I able to trade on it and make any money? So that we have generally seen does not happen, or no conclusive evidence there is of the lagged movement based on order books. People also try to use currency option markets so as to understand the movement of the currency. For example, if the implied value of a call is higher than that of a put, so a call option is being overpriced and a put option is being underpriced, it may likely be the case that people are expecting the currency to move up, and hence call option is being priced higher than a put option. Similarly, it can be vice versa. If call option is being underpriced and a put option is being overpriced, it's because people are expecting the currency to move down, and hence puts are being valued more. Again, evidence shows limited predictive power of such indicators. So a lot of technical analysis may be used, but general research concludes that there is no definite trend or there is no definite conclusion that can be drawn with regards to any of these indicators. So that's about currency and exchange rate parity relations, an important topic, a complicated topic, not a very heavy weight on the exam, but still make sure you understand the concept and you practice a lot of questions. In case you don't understand any part or you forget any part, make sure to watch the video once again before the exam so as to refresh everything. Books generally at times may not be able to explain on the concepts in a lot of detail and can get confusing if you're reading. So thanks a lot, and see you next time.